Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up here, we'll break down the market sell-off and how to position as the S&P 500 looks to officially enter into a bear market. Plus, we'll bring you the latest on trade negotiations as China prepares for a trade war with the U.S. by front-loading stimulus measures. And billions of dollars of deals and IPOs are on hold amid the trade-induced market volatility. We'll discuss what it means for Wall Street and when transactions will resume. All that and more coming up on Catalysts. Half hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages here, you do have your S&P 500 currently at levels that if we were to close at would officially put the S&P 500 into bear market territory, among the fastest slips into bear market territory in history. You've got your NASDAQ, your tech-heavy names down a little over 3.5%, but I am fascinated by the move we're seeing in the bond market this morning here. The yield curve biased towards more steepening moving forward, and given the stock sell-off that we are seeing here, it'll be interesting to see what happens. You've got two big bond market auctions this week. Will we see pressure on global demand for U.S. stocks amid the trade war? That could certainly play out in the action here. You are seeing the front end of your yield curve coming in just a bit, but hovering around the flat line, as you can see on your screen. And I want to round it out here with Bitcoin, because we are continuing to see selling in Bitcoin here, down keenly below that $80,000 level. Well, I want to bring in Chris Watling. He is a global economist and chief market strategist at Longview Economics, and he's going to be my guest host for the hour on a very special day, day 3 of this historic sell-off. Chris, talk to me about how you're viewing this moment. Is the market pricing in risk of a slowdown or a full-blown recession?
Well, great question. I think in the immediacy of the last couple of days, we're almost in a liquidation phase. So the market's pricing in huge uncertainty, clearly triggered by Wednesday. But let's not forget, this pullback started in mid-Feb. Yeah. It's been an evolution. And in some ways, we're probably close to, well, obviously close to the end in the beginning by definition. But in the sense that, we've come a long way. We're 20% down, as you said. I mean, that's a bear market associated with the recession. Not a bad one, but it's a bear market associated with the recession. So I think opportunities are coming, and that's what we need to focus on. You've got to hold your nerve. These are the sort of times when there's sort of volatility, serious pullbacks. These are opportunities in markets to pick things up and start nibbling, as we like to say.
So where do we nibble right now, and how do you think about where to find the nibbles in this environment?
Well, you want to think about your medium-term macro outlook and what sectors are going to start leading the market as we come out of this and as things start to settle down. I realize we're a long way from that, and there's a lot of iterations and chapters and issues to go through in terms of tariff negotiations and so on. Yeah. But let's not forget, Trump's agenda was initially negative for growth and later on positive for growth. Let's not throw out the baby with the bathwater, as they like to say. So I think into weakness, look for cyclical areas of the global stock market, look at mid, small caps, this sort of stuff. For now, we've been defensive for the last couple of months, but we're starting to think about trying to start to turn that tanker, if you like.
Mid and small caps on an individual name basis, or do you think folks can own an index fund?
Well, I think at some stage you can start owning an index. I mean, I think I was reading the Russell 2000 is down over 20% from its highs, back to pre-Trump election levels, that sort of stuff. These are much cheaper areas of the market. In terms of individual stocks, we don't do individual stocks, so you need to know your stock. Some are more affected by catalysts than others. Right. Nike's a great example. But again, I think there's a ton of opportunities brewing out there. And this is the great thing about sell-offs. I love sell-offs. They create opportunities. They
create opportunity, but it's difficult to time it. So I am going to ask you, for investors who, let's assume our audience has incredible investor hygiene. We're talking to the highest level of investors that are watching their screens and their trades all day, every day. How should they think about timing the pullback? And I want to pull a chart from the notes that you sent over to us as well, looking at how investors can think about this moment and when to sort of time the buying opportunity.
Yeah, well, I mean, that's a great chart, isn't it? You can see we're already back at the lows from, I think I can't actually see because it's a long way away. Is that 2022?
Yeah.
2022. So this should come down a long way. That's the bottom of the bear market. This sector's come off a lot. A lot of cyclical sectors, and consumer durables are one of those, although you've got to be slightly careful in terms of the Vietnam story and the Nike story and all that sort of stuff. But a lot of cyclical sectors haven't really done anything for 2 or 3 years. And we're going to get more rate cuts on the back of this. So actually it's good for cyclical sectors. So that's not really a market timing chart, that's more sort of sector chart. Some of the other charts in the piece I sent you are good market timing charts, and a lot of them on buy, even strong buy.
Right.
And they're good for a bounce for a couple of months.
I think we've got the wrong chart up there, but I do want to quickly get your answer to this. How should investors time the pullback?
Well, if you look at market timing tools, look at models, the market's very overextended to the downside. There's a lot of fear out there. Take the VIX, for example. We're up at 50% on the VIX earlier today. That's an extremely high level. That's when you start nibbling, because that's telling you about capitulation, potentially. It's telling you about liquidation. It's telling you about panic selling.
Yeah.
You want to buy when people are panic. You want to be greedy when they're fearful and fearful when they're greedy.
Right, exactly. Well, Chris, we're going to have you here for the hour to help us understand when investors can be greedy amid all the fear that is clearly dominating the market. But I do want to turn over to our next guest for a chat on currencies. Let's talk about the dollar ticking lower today. The greenback's seen sharp decline so far this year, with dollar weakness indicating investors are seeking safety in global markets outside of the U.S. Here with more on the future of the dollar as a haven trade, Jane Foley, the head of FX strategy over at Robobank. Jane, amazing to speak with you. Thank you for making time with us this morning on a very important day in terms of the currency trades here. The weakness of the dollar right now, how do you read that weakness? What is it signaling to you?
Well, to be honest, at the end of last week, it was a little bit unusual, where you had the safe havens, the yen and the Swiss franc certainly been sought after. The dollar was left out in the cold. Now, clearly, there was something to do here with the anticipation, of course, or that the market could be reevaluating the whole view of investment in the US. But the US dollar, like it or not, is the global reserve currency. It is a huge invoicing currency. And if this crisis were to worsen, there no doubt would be, to some degree, a shortage of dollars somewhere, as people need their dollars to pay their invoices, etc. So it was unusual to see the dollar faltering to the extent that it did at the end of last week. Now, this morning, things looked a little bit more usual. For instance, overnight, the Australian dollar falling heavily, the New Zealand dollar down heavily, commodity currencies here, including the Canada, including the Norwegian krona, all falling against the US dollar. So the dollar, if you like, becoming more of a safe haven, certainly against those commodity currencies, which is perhaps what you might normally expect in a sort of crisis. Now, at the top of the pile this morning was still, of course, the Swiss franc and the yen. I've got to also mention that there was pretty low liquidity in some of these countries, meaning that there was, very, very sort of loose ranges here as well. But I think the remarkable currency here has been the resilience of the euro. Yes, it is off its highest levels against the US dollar, but it has been extremely resilient. I think we could really do with a little bit more of a pullback in euro dollar to normalize the situation here, because like I say, like it or not, the dollar is a currency that people need when things become stressed.
Yeah, what is the currency hedge to sort of win them all right now, Jane? Is it the euro in your view?
Well, that, I think, has been the view over the last few days. Sure. The euro, I mean, certainly it has underperformed, the Swissy and the yen, as you might expect, but it's done remarkably well. But that makes me feel pretty uneasy now. Yes, the fundamentals of the Eurozone, a month ago certainly improved, and that was with the debt brake being adjusted in Germany. The outlook for growth, for instance, in the region really taken a step higher. But there is a question of timing here, because big forecasters in Germany are putting up their 2026 forecast for German growth and onwards, not their 2025 forecasts. A lot of the projects that will have to be done by Germany in terms of defence and infrastructure are not necessarily shovel ready. So there is a timing issue here. I think there's potentially room for disappointment, therefore, in some of those bullish calls. So whilst we haven't adjusted our medium-term target of 112 for euro dollar, I think there is perhaps a little bit of room for the dollar to come back against the euro over the next month or so. And that would be, I think, a more normal condition, because we can't get away from the dollar's purpose as reserve currency.
Hi, Jane. It's Chris here in the studio. I was intrigued by what you were saying about the dollar, because, of course, the dollar into the Trump election and the expectation of tariffs round one was strong, and that was the whole discussion, wasn't it? That tariffs absorb the dollar absorbs part of the tariff move. What do you make of the fact, though, that tariffs announced higher than expected Wednesday last week and the dollar goes down? How do you feed that into your thinking?
Well, I suppose this is exactly what I'm saying. To me, it was a little bit unusual. I mean, certainly the market has been anticipating since January that the Fed will look more on the growth side of its mandate rather than the inflation side of its mandate, and that is, of course, why the dollar has been falling, since around about the time of the inauguration, and one of the prime reasons why it fell so much at the end of last week. The market, of course, now priced for several interest rate cuts from the Fed, but as you just mentioned, inflation is also a consequence of tariffs, and it is quite possible that the Fed won't be able to cut interest rates as much as the market is anticipated, but then nor will other central banks too. The market's been pricing in a lot of interest rate cuts from the RBA, for instance, or from the ECB and a host of other central banks. Be interesting to see what the RBNZ does tomorrow, whether it sticks to its guns for its signal 25 basis points move, or if it does more indeed, because that could get the market more excited that other central banks could do the same thing and cut. But I think it is unusual that the dollar has fallen so much and has sort of ignored its safe haven status, and that's why I think euro dollar can fall back in the next few weeks.
If we start to see this current moment withstanding, where we are seeing the dollar moving up a bit, but if we continue to see this dollar weakness narrative being a little bit sticky, Jane, how do you think about how that affects kind of the impact of these tariffs, and how does that play into the economic risks of the tariffs as well? Does a weaker dollar make the impact of tariffs more potent?
Well, a weaker dollar could certainly increase the inflationary aspect for US consumers. I mean, that's why, generally speaking, or one of the reasons why normally you'd expect the currency to go up, because tariffs mean a consumption tax, if you like, for US consumers. That the Fed would become more hawkish, the dollar would go up, and therefore some of the inflationary impact would be dispelled. The weaker dollar, if it were to continue, would indeed indicate that the inflation impact for US consumers could indeed be worse, and therefore it doesn't necessarily sit with the idea that the Fed would be cutting interest rates anything like 5 times as much. So there's a lot really to wash out here. We had the indication from Powell on Friday that he's going to wait and see. He's in no rush to come to the market's aid and cut interest rates quickly. And I do think that if that's the case, that the market might again start to price out some of those cuts that it's been pricing in over the last a few hours, really, or the last couple of days.
Interesting, Jane. I suppose ultimately the question comes down to how much do you think tariffs are inflationary and how much do you think they're a tax on the consumer and therefore a hit to growth? Because that really will drive the Fed's narrative. How much are they prepared to look beyond the sort of short-term hit on inflation expectations? And if I'm right, I think 1-year inflation expectations are up a lot and 10-year are actually going down. So the market's already grappling with that. Where would you sit in that camp?
Well, I suppose nobody really knows. I mean, you could take a very straightforward textbook approach and say, yes, these are going to be a one-off, which, of course, is why the Fed's Powell reintroduced the word transitory a week or two ago when thinking about the impact from tariffs. If that's the case, then the Fed will be able to look through them. But other economists have cited the fact, well, they're not really going to be transitory. There could be sort of knock-on effects, or these tariffs could come through at different points of time. And actually, the net effect that we get is something that lingers for a little bit longer, particularly if higher inflation is then built into wage negotiations, etc. So it's very, very difficult to know that right now. And again, another reason I think for the Fed, to sit back. But by using the word transitory a couple of weeks ago, well, the Fed gave the market a free pass to think, the Fed will just be concentrating on the growth aspect of its dual mandate and not the inflation aspect. So if you like, that's what that word did to market expectations. And I think we need to see what other Fed officials say, or, the data, but it's going to take a while before we get post-tariff data to see whether or not, the Fed are really worried about the impact of this inflation or not.
All right, Jane, we got to leave it there. Thank you so much. Amazing rundown from you, as always. Really appreciate it. Thank you.
Thank you.
Let's do a check of the markets here, because this is fascinating. We are seeing stocks moving into the green and bond yields soaring as well. You've got your Dow Jones on your screen right now. I wonder if we can see the S&P 500 and your tech-heavy NASDAQ as well, which are also continuing to move to the upside. You've got your tech-heavy NASDAQ up about 2.5% at the moment. Your S&P was up as much as 2%. We were seeing some interesting individual stock action. So let's bring in our guest host, Chris, here to discuss. So, Chris, we saw about 90% 10% of stocks this morning not in the decline. And now you're seeing that obviously leading to stocks flipping into the green this morning. What do you think happened? Like what changed?
Well, I mean, the point is it's a liquidation event. So at some stage, we're going to get capitulation. And once you get capitulation, we start going the other way. So what happens in liquidation is people sell what they can as quickly as they can at any price they can. So they're forced sellers and they buy a lot of puts, they buy a lot of downside protection. And then eventually the selling sort of peters out, and then you get the short covering. That's what, and you get the V-shaped price action, you get it on heavy volumes. So, you know, maybe we should actually be trading, not doing this show. I think, frankly, there could be, you never know, this could be a really good buying opportunity, at least for the next few weeks or a couple of months. There's a lot of fear out there. You know, what did we have on Friday, the weekend? We had a parallel to the 1930s. Yeah. Goodness me, I don't buy that at all. I mean, I understand tariffs and Smoot-Hawley and all that, but, you know, we had recession risks going up. We had everyone downgrading everything. These things happen at the end of moves, not the beginning. The fear's endemic in prices at the end. So you want to, as I say, buy greedy when people are fearful, fearful when they're greedy. They were greedy in February. They're now fearful.
Well, then, did we hit a bottom already? Or are we going to see more selling?
It's possible. I don't know. I mean, we can't tell yet. We have to see what the price action looks like over the next 18, 24 hours. We have to look at the volumes, but it's not impossible. We're getting towards that point. It wouldn't surprise me. They say it's normally turnaround Tuesday, but maybe it's something Monday. I don't know what the term is.
So it sounds like you would be a buyer at these levels. I know you don't typically talk individual names, but Nvidia briefly hit the green this morning, and it seems like the broader averages then moved into the green after that kind of move. How are you thinking about a name like Nvidia at these levels?
Well, you're quite right. You've got to think about Nvidia. This is a key leadership stock in the market. When I was on in August, I remember we talking about every man and his dog owning Nvidia back in August last year. And sure enough, it topped in July, I think, because it was over-owned. And now there's over-panic and it's overextended to the downside. I think you may or may not have a chart, but we're getting a rare technical buy signal on Nvidia, which gives you a bit of comfort. You can see it's a very low level, similar to where it was towards the end of the 2022 bear market. It gives you a bit of comfort. You can at least get a multi-week rally out of it, maybe a couple of months. Beyond that, it's more about the fundamentals, but technically it's looking quite interesting, and a lot of the market's starting to look like this.
So is today a day for buyers to get in across the board?
Today is a nibbler day.
Okay.
There we go. That's not a great term, but you know what I mean.
No, I understand.
Yeah.
Find those opportunities where you believe in the fundamental story.
It's not all over. We might rally and then retest. You know, there may be some more, but we're starting to find a low, I suspect.
All right, Chris.
For long-term investors.
Great overview. Thank you so much. Appreciate it. We're going to have more for you ahead on Catalyst. Stick around. SIBO VIX volatility index in the high 40s right now after spiking close to 60 in the wake of President Trump's tariff announcement, with BTIG technical analysts saying the so-called fear gauge is at a level indicating panic. Stocks are moving to the upside right now, but with uncertainty still high, investors may be looking to the options market for potential plays. For more, we've got JJ Kinahan. He is the CEO of Tasty Trade. JJ, always a pleasure to speak with you.
Hey, Madison.
Talk to me about what you're seeing right now. We've got stocks flipping into the green at the moment. You've got your S&P up nearly 1.5% after record selling. Just want to start there before we get into options. What are you kind of seeing playing out in terms of the price action this morning?
Yeah, well, it was crazy. Talk about panics. I sat in a chair about 10 minutes ago to do sound checks, et cetera. And all of a sudden it was a panic to the upside. What's happened over the last 10 minutes has been absolutely unbelievable. And you think about, where we've come from just in the last little bit here. You saw VIX that, as you started, was just over 50 earlier this morning, now trading about 42. In fact, it got down to about 38 a few moments ago. But overall, what it's telling you is that people are still coming for protection. People are afraid of the downside. And, we went through this long period with very little volatility, and volatility came quickly. It's the old expression on Wall Street in general. The market goes up the stairs and goes down out the window. And it certainly took a dive out the window here. And again, VIX being a correlated product, and that as we go down, volatility goes up. You saw the exact opposite happen with VIX, and that it did explode over the last few days. That said, I think for your viewers overall, particularly your retail traders, take a breath. because you can see how volatile just this morning has been overall. And I think the thing you really have to do is, if you're going to be trading right now, really think in partials and think smaller amounts, because things are happening so quickly. There's no reason to have to pay off or sell bids, put things in at prices you like. And the market's natural back and forth on days like today give you an opportunity to get things filled at a nice price. But again, if you go in too big to either buy or sell, I think you're going to regret that later.
So do you recommend, or how do you think retail investors should be thinking about buying at these levels now that we are seeing a little bit of a move to the upside?
Well, I think that one of the things you want to think about for those who are comfortable trading options, this is a time where, stocks like Apple, you can go pretty far out of the money. You can go to the 125 puts and get over $1 for that put. What does that really mean in simple terms? That means that if Apple stays above 125, you keep your dollar. But if it happens to go below there, your actually break-even price is 124. Are you comfortable buying Apple at that level is really the question you have to ask yourself. But because volatilities are high, this is a time those who want to buy stocks will often use selling puts in order to do so. The thing I like about that strategy during times like this is that even if you're wrong, you make money. What you're trying to have happen is you buy the stock at a level you want. But if you're wrong and the stock goes straight up and you never get to buy the stock, you still make money because you keep the premium. That doesn't happen too often on Wall Street, where you're wrong and you can still make some money.
And JJ, just to add to the confusion at the moment, stocks are back to being in the red. And now that we have been talking a little bit, you've got your S&P off about 0.7%, and your tech-heavy NASDAQ off about 0.7%. But I do want to bring our guest host, Chris, back into the conversation. Chris, how are you thinking about this move this morning, and anything that you want to ask JJ as well in terms of the options action?
Well, I am totally with JJ. I understand the point. There's a lot of volatility out there. Quite right. I'm curious, though, about how much put buying you think the market's done in aggregate, because obviously it's a terrific indication of fear, and it was building last week. Would you say we've almost done enough put buying? I mean, that's often a sign the market needs to find a floor, at least temporarily.
Well, yeah, and you did see people buy more puts than calls. I think you have to be a little bit careful of looking at that, Chris, for one reason, and that is you're not sure, A, why people are buying them and what's on the other side of the trade. Again, options being a derivative product, you're never quite sure what people are doing it for. But to your point, we saw the biggest amount of options ever trade last Friday. We saw puts and calls fairly even, which you don't normally see. To your point, Chris, it's usually more calls than puts. So people have absolutely been coming in for protection. And so, you're seeing VIX hold up. When you see VIX hold up, shows me that they may not be as aggressive in their buying, but they're certainly there to buy. There are very aggressive bids for puts. It's not backing off at all. People want protection. And quite honestly, people may want protection both ways, because we just saw how quickly the S&Ps can rally 200 points and come back down. So you may see people who are buying both sides, or if they're long stock, selling their calls in order to buy puts, because they want that protection and they just don't want to pay a lot for it.
So, JJ, as we get to wrap up, and it's funny, Chris had just mentioned that exact same thing earlier in the program here, but JJ, what is your single best idea for investors right now who are freaking out about their portfolios, who want to hedge?
I'll give two, because of her single greatest idea is to say stay small when things are going crazy and not trade very big overall. The second thing I would say is really, and it's what we see in our client behavior overall, you probably want to go to more broad-based index rather than individual stocks right now, spiders, QQQs if you want to trade ETFs, or, SPX, NDX if you want to trade the big boys. And the reason being, you're not, with earnings coming up, et cetera, you have a single stock risk coming up starting this week, which on top of everything that's going on in the overall market, I'm not sure most people want to take on right now.
All right, JJ, always great to have you. Thank you so much.
Thanks, Madison.
Coming up, what a new round of China stimulus could mean for the Asia markets next on Catalyst. Stick around. Let's do a quick check on the markets here. You're looking at your major averages flipping back into the red. Now, we very briefly had the stock market flipping into the green here, but now you can see we are back in the red. You've got your S&P off about 0.7%. Your tech-heavy Nasdaq down nearly 1% here. Your S&P above where it would be in terms of closing in a bear market. That's around the 4,900 level. So if we closed at these levels, the S&P would not be in a bear market. But just to contextualize you guys, the S&P rallied more than 8% in the last 10 to 15 minutes, and then we saw it declining over 4%. We are getting headlines in that Trump is considering a 90-day pause in tariffs for all countries except China. So perhaps that scoop, which we have yet to confirm on our own, is what is leading to a little bit of the buying that we are seeing in stocks this morning, or the market was just a little bit oversold here. So let's get to our next guest to discuss, because Chinese officials reportedly weighing a new wave of stimulus to counter U.S. tariffs, according to Bloomberg. The potential measures come as deepening fears of a widening trade war with the U.S. has roiled global markets. Hong Kong's Hang Seng Index led declines among Asia stocks on Monday morning, suffering its biggest one-day drop since 1997. Leland Miller, China Beige Book co-founder and CEO, is joining us now. Leland, great to speak with you this morning. Thank you for joining us. I want to start on what we're seeing in terms of China reacting to the United States here. Do you think that there is any opportunity to make a deal with China when it comes to tariffs, or has the U.S. kind of overplayed its hand when it comes to Beijing?
No, I don't think this is pro or negative a deal. There was always going to be run up in any negotiation, or any run up to a negotiation. There was always going to be an increase in leverage. The U.S. was going to raise tariffs. There was going to do a bunch of other things, and then it was going to offer to take some of this stuff off if Beijing did what Trump wanted them to. So I think that this doesn't really tell a story about whether there could be a phase 2 deal negotiation or not. What you are seeing is a ramp up in tariffs, very dramatic, much more than markets expected, and then an expected Chinese response, which was meant to look reciprocal, but really hits tariffs and a bunch of other things. So I don't think this tells a story about a phase 2 negotiation or not. I think it tells a story that China has not yet been, but will soon be, the story when it comes to tariffs.
And so China, as you know well, has several kind of measures that they can enact here. They can retaliate, capitulate, devalue their currency, or issue stimulus, or a combination of all of them. Which do you think is most likely from China, or do you think it's all of the above?
Well, it depends what happens. I mean, right now, what China's been doing for the last several months has been arming the gun. It's been prepping the ground for a bigger fiscal stimulus if they need it. It's been offering up the idea that monetary stimulus will continue and accelerate. So there's all these things that are, arming the gun for when they see how the landscape plays out. Look, Wall Street has predicted 25 of the last 2 big stimulus blasts. So, the headlines are always going to be the same. China's going to do stimulus. China's going to do stimulus. It's never really been true. It's interesting now because if you look at our latest data, we were actually seeing transport construction firms, which are our best proxy for infrastructure and fiscal spending. They did start ramping up their borrowing last month and the month before. They are looking at the possibility of doing something bigger, but I think you're going to actually have to see what the landscape is before China sort of pulls the glass on any pulls the lever on any of these sort of bigger moves.
Leland, what about this idea that this is going to force China to reinvent their economy, move away finally from that export-driven model primarily to an infrastructure, more to this sort of consumption-based model? This has been a bit of chat in the markets over the last 6 months, accelerating in the last few weeks or so. Is it possible that China can drive their own growth that way, tapping all those household savings and so on, rather than the old model of infrastructure and exports? Where would you be on that debate?
I think the debate is total nonsense. There's no evidence whatsoever that's going to happen beyond constant statements that we are going to shift from investment to consumption, which we've been hearing for a decade now. If you see some of these very large tariffs continue, then yes, China will have to restructure its economy, but it's not going to restructure its economy toward consumption. It's going to restructure its economy towards sending its overcapacity everywhere else around the world. So the second the U.S. shuts itself off or partially shuts itself off, they're going to start sending more to Europe, more to Southeast Asia, and more to the rest of the world. So unless the rest of the world has a policy response, which it might in time, then China is going to just double down on its double down, which is more production, more exports. And look, this is not going on out on some crazy limb. She and the government and the party have said this over and over and over again, that they wanted to rely on new quality productive forces. They wanted to produce more. They wanted to have a whole of government effort to export to manufacturers, to dominate the fourth industrial revolution. These are things they've been saying. I think we should finally listen to them.
How willing do you think China is to address their surplus if that is kind of the end goal of Trump's tariffs?
I think that if the ask from the U.S. administration is simply, buy more commodities, do more purchases, et cetera, I think China would be very open to that. It doesn't require any type of restructuring. It just has to require sort of a short-term-ish agreement to narrow the trade deficit and make the numbers look better. I think that if all their problems went away from this administration, and that was all they were asked to do, they would be very interested in that type of deal. The question is that the type of deal the Trump administration is going to offer them? I think it's very hard to believe that all you're going to see in a potential phase two would just be phase one all over again. So I think that there has to be a set of asks from the Trump administration before you can evaluate this. But it very much depends on what the Trump administration is asking Beijing to do.
All right, Leland, we got to leave it there. Thank you so much. Really appreciate it.
Pleasure.
China backed off a deal to sell TikTok over opposition to the latest round of tariffs, the president said on Sunday. Take a listen.
We had a deal pretty much with TikTok, not a deal, but pretty close. And then China changed the deal because of tariffs. If I gave a little cut in tariffs, they'd approve that deal in 15 minutes, which shows you the power of tariffs, right?
Before an additional 34% tariff on China was announced on April 2nd, a deal was reportedly close. According to the Washington Post, an agreement was set to be announced last Thursday, but Chinese officials insisted on tariff negotiations first, and the deal fell apart at the last minute. Congress last year passing a law requiring that TikTok parent company ByteDance either sell the app or face a ban in the U.S. by January. President Trump delayed that deadline by 75 days, vowing to save the popular social media app by brokering a deal with a U.S. buyer. O'Leary Ventures chairman Kevin O'Leary, who joined Frank McCourt's bid to buy the social media app, spoke with Yahoo Finance on Friday about the complications surrounding the would-be TikTok deal.
The current idea is to get a copy of the code and make an American version of it, and we're not sure that passes muster with the law. We need clarity on what's allowed and what isn't based on the law that was passed by Congress and the Supreme Court order. Remember, it was 9-0. There was no ambiguity in it.
In lieu of a deal, President Trump extended the divest or ban deadline by another 75 days on Friday. Coming up, retailers bracing for the impact of tariffs, what investors should expect from the sector next on Catalysts. The White House coming out moments ago to shut down reports of a 90-day pause on tariffs that exclude China. Those levies, of course, going to heavily impact the retail sector moving forward. Many big-name retailers have previously warned about the potential impact on prices. Best Buy, Target, Dollar General, and Abercrombie & Fitch all saying they may be forced to pass on price hikes to consumers. Joining me now, Seth Basham, Wedbush Securities Managing Director of Equity Research for Retail Hardlines. Thank you so much for being here with us this morning, Seth. Really appreciate it. Talk to me about how you are thinking about the retail sector in this moment and whether or not, are there any names that are not going to pass these prices on to consumers, or is that kind of an eventuality in your view?
If the reciprocal tariffs stick, there's inevitably going to be higher costs passed on to consumers in the form of higher prices. There's no retailer out there that can withstand these higher costs and stay in business without passing some of them on to consumers.
So what are some of those names that have pricing power right now?
In terms of pricing power, within the hardlines group, some of the best companies include the auto parts retailers, AutoZone and O'Reilly Automotive as examples, and then some of the mass merchants who focus mostly on staples like Walmart and Costco would be other examples of companies that have the ability to pass on price most easily because they're selling mostly non-discretionary goods and their consumer tends to be mass market or low income to some degree, but you're selling non-discretionary goods and consumers have to buy those goods in order to continue their lives.
So what do you reckon is the sort of impact on margins? It'll obviously vary company by company, but give us a flavour of what this might do to some of the retailers' margins. And presumably, once they take the hit in year one, year two doesn't have that much of an effect. There's probably some working out of things, moving supply chains and so on. Can you give us a feel for that?
Yeah, it really will vary dramatically by company. In terms of the examples that I just gave you, the auto parts retailers will see very minimal hit to margins. They'll be able to pass through almost all the higher costs in the form of, gross profit dollars maintaining the same levels, gross margins coming in. But EPS should not be hit too much. There'll be a trade down effect within the auto parts retail space where some consumers decide not to go out and buy new vehicles, instead maintaining their existing vehicles, which helps support sales along with the higher prices from tariffs. So we expect limited impact on profitability for those auto parts retailers. On the other extreme, if we see these tariffs stay in place, the more discretionary oriented retailers like the home furnishings retailers, the home improvement retailers, take a Home Depot, take a Williams Sonoma, we could see a recession unfold, and we could see them not being able to pass through all the higher costs in the form of prices, so that we could see margins come under material pressure, 200 plus basis points, earnings come down in the 10 to 20% range.
And as we know, Seth, markets move ahead and price in a lot of often overpricing news. Are there opportunities brewing in those sectors the hardest hit? Would you be thinking about picking up some of those stocks, nibbling on them?
Absolutely. Today, we recommended investors scoop up RH, Restoration Hardware. That stock has been decimated since the announcement of reciprocal tariffs in their fourth quarter earnings report. They have high exposure to Southeast Asia, where the tariffs are severe. But we think the more likely scenario is that this is a negotiating tactic for Trump, and we'll see those tariffs dialed back or eliminated when this is all said and done, which really creates a solid footing for the earnings power of RH and a discount on the stock today.
All right, Seth, thank you so much. Appreciate it.
You bet.
Another sector we're watching today, airlines, with Delta set to kick off earnings this week. Brad Smith is here now with a closer look at what we can expect. Hey, Brad.
Yeah, thanks so much, Maddie. Well, Delta earnings kick off this week, and here's what to watch, especially as we're going to be watching for how this airline really influences much of the chatter, both on the street and the analyst perspective, all the way through to the corporate executive perspective around navigating travel and leisure and the experience economy in what is continuing to be a very contentious consumer environment right now, especially given some of the most recent measures that we've been tracking in consumer confidence and consumer sentiment. Most notably here, as you think about the backdrop that these companies are entering into this earnings season with, you think back to consumer confidence a couple weeks back. Yeah, there's a lot of people out there that are still saying, I need to get away for just a little bit here. And so travel and some of that experience economy spending is still anticipated to move higher. You've got more of those consumers saying they're willing to spend on that, but the dollar figures are going to be able to come into a little bit more focus with some of the forecasts that we get starting this week with Delta. Here's what Citi is going to be watching as we move on throughout the rest of this earnings season, especially thinking through Delta kicking things off. And this is the more premium carrier out there among the airlines here. And what you'll note specifically here with this is this co-branded card remuneration, i.e. how many people are using some of those rewards or swiping with their Amex or some of those other partner cards. So Delta, that comes into play from Citi's perspective. For American, what they're focusing in on there is the most domestic exposure. That's the airline that has the most domestic exposure here. And then additionally here, think about United. Now, this has the most international exposure, but this is also a period where United is spending to become even more premium as compared to Delta as well. And then lastly here, Southwest has been making some moderations with its own policies. Yeah, we're talking about those baggage fees out there where bags may not be flying as free as they were before. That's going to be coming into focus. We'll see how much that also flows through to some of the outlet and what that means for some of the navigating consumer sentiment there. And the risky strategy is what Citi is calling that. And so we'll continue to watch all that going forward throughout the rest of this earnings season as we kick things off. Maddie?
We certainly will, Brad. Thank you so much. Appreciate it. We'll have all your markets action ahead, so stick around. You're watching Catalysts.
Heading into the second Trump administration, the thinking among investors was the new president would lighten regulation and revive deal-making, a major plus for U.S. banks. But recent reality is definitely poured cold water on that optimism. I'm Jared Blickery, host of Stocks in Translation. So let's do a reality check of big financials so far under the Trump administration. I'm going to start here with the sector action, and I have in white and in green, as I've been doing for the last week, I have the election to the inauguration. So these were the expectations coming in to mid-January, to that inauguration event. And then here in green is what we have had since. And you can see consumer discretionary was leading 13%. Financials, what we're talking about today, they were number 2, up 7.5%. But as of Friday, they were down 12%. As of today, I have lost track, but significantly more. Consumer discretionary and all the other sectors down too. I have all the sectors in here, but I do want to move on. You can see a lot of these like healthcare, consumer staples, and real estate, not up or down very much as the others in this time frame. We got to get to rates because here I have the U.S. 13-week Treasury rate. So this is a T-bill. This is basically what tracks the short end of the curve. This is what the Federal Reserve is doing. Then we have the U.S. 5-year yield. Then we have the U.S. 10-year yield and the 30. And the 10 and the 30 are more important. Really interesting to see how they jumped up in anticipation of this new presidency and how they have crashed now. That is because we are now in recession fear territory, and that has an opposite effect on the market. I want to get to the banks here finally, and we can see Wells Fargo, Goldman Sachs, Morgan Stanley, JP Morgan, Bank of New York Mellon, BlackRock, all giving back all of their gains in most cases, sometimes even more. Jamie Dimon out this morning with his shareholder letter saying the recent tariffs will likely increase inflation and are causing many to reconsider the possibility, a greater possibility of a recession. So for more jargon busting, deep dives, new episodes on Tuesdays and Thursdays on Stocks and Translations on Yahoo Finance's website or wherever you find your podcasts.
Jared, thanks so much. Several companies, including Klarna, StubHub, and Chime, reportedly delaying or considering delaying their initial public offerings amid market sell-off triggered by President Donald Trump's announcement of broad reciprocal tariffs. The market sell-off put the brakes on what was expected to be a revival of IPOs here, with Renaissance Capital saying its IPO ETF had its worst week since March of 2020. For more, I want to bring in Angela Lee, 37 Angels founder and Columbia Business School professor. Angela, great to speak with you here. What would it take to get the IPO market back on track?
Well, investors and founders want to see stability, and we are in an incredibly unstable place. I'm sure a lot of you follow VIX, which is a volatility index. We are at the third highest point since in the last 20 years, right? So the only time we've seen more volatility was March of 2020 during COVID, and then October 2008 during the Great Financial Crisis. Right. And nobody wants to IPO into that sort of market. And unfortunately, we have a pretty bad precedent with CoreWeave. So CoreWeave IPO'd just a week and a half ago, and their share price dropped 22% just last Thursday and Friday. That is a really scary market to go into.
Absolutely.
So what was the pipeline like coming into this in terms of size? There's lots of big names, but was it a very big pipeline that's now obviously gone to zero?
Yeah, we have a really big backlog in the IPO market right now. It's been very depressed for 3 years, and everyone was saying 2025 is going to be the year where things are going to come through. Unfortunately, it doesn't look like that's going to be the case.
I wonder, Angela, too, how you're thinking about the impact on small businesses that we're potentially planning to sell this year. I got a lot of questions about that over the weekend.
Yeah, we're in this really scary cycle because VC companies and PE companies, they will go out and raise money from their investors, and they need to return that money to their investors in 10 years. When that doesn't happen, they can't raise new funds, which means that new companies are not going to be invested in, and that really hurts innovation and growth.
And how do you think about how that impacts kind of the self-fulfilling prophecy then of the IPO market? Like if you're not seeing that growth, then later on you maybe are not going to see as many IPOs.
Absolutely, and it's this thing that also takes a really long time to work its way through the market, because if the next Airbnb, the next Uber doesn't start right now, then we're not going to see that company IPO in 10 years. So this is a very, very long-term effect.
Angela, great overview. Thank you so much. Really appreciate it. $7 trillion. That's how much the market moved within 1 hour this morning after unconfirmed reports of a 90-day pause in tariffs. The White House quickly calling those reports fake news, but the market was already running ahead with it. The S&P 500 up as much as nearly 8% at one point before the White House rebuffed those reports. I want to bring in Chris Watling for more. Chris, what does the degree of this move signal to you about the market right now?
I think it signals the market wants to rally. I think that's what it's telling you. Give it a sniff of something that's good news, and whoosh, off you go. There's a lot of downside protection in this market, a lot of fear. So, I think that's really quite interesting. I mean, I know it's fake news, and I know it's given it a lot of it back, but that is a very, very big move in a very short period of time. So, it's indicative of the way the market's positioned.
That the gravitational pull is maybe still to the upside. Chris, thank you so much. Really appreciate you making the time for us. Coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Brad Smith, he'll have you for the next hour, so stay tuned for more. And I do want to thank Chris again for joining us. Really appreciate you for coming in for the hour here as we have continued to see just a very volatile day. So you really got your sea legs under you for your first time guest hosting. Chris, won't be the last. Thank you so much. Appreciate it. Stick around for more.